Believe it or not, viewers and listeners, I'm about to pull up a meme from Reddit. This may be the last time I do this. I might regret this, but I want to talk about. As we had kind of hinted at earlier, this concept of loss porn, as they call it on Wall Street Bets. So what we're referring to here is a chart that looks a lot like this. You see, if you're on Wall Street Bets, this is so freaking familiar to you. You only see screenshots of either the chart going down like this or the exact mirror image of this. That's the only screenshots that people ever post. So the title here says it all. Can anyone guess when I discovered options trading? And so I want to just use this as a bit of an intro to a discussion about how portfolios tank. So Todd, take it away.
Yeah, what causes implosions like this? You can stop sharing that screen. Yeah. That's horrible to look at. I don't even want to see that loss.
It hurts.
It hurts.
But yeah, options trading can definitely cause that, right?
Absolutely. Absolutely. I've been thinking a lot. As you know, Joe, because you took the class with me, I teach a class how to talk stocks at the University of New Hampshire. And, we've got a lot of students in there now who are, eager future stock gurus. They're loving it and they're trading and everything. I started thinking a lot about what we've seen the last couple of weeks and thinking about the other side of that. I mean, yes, you have people who made money, but you got a lot of people who lost money too. Oh, yeah. And, one of the things I want to try and do is kind of, help people understand the risks that they run and the things to look out for. So I started thinking back over the course of my 30 years or so investing now and think about the things that I've seen that have caused people to implode. So how do you define implode? I mean, like you made money and then you wiped out, right? So, it's like a yard sale on the ski slopes, right? You're going down, you're doing great. And then all of a sudden you're in the woods and all your stuff's off you and everything else. Yep. So what causes those implosions? And there's more, I'm simplifying it, but there were three big buckets, Joe, that I think that you can stuff most of the reasons that people implode into. And they are lifestyle, leverage, and mindset. So I think that, lifestyle, leverage, and mindset, those are the three places where we tend to make the most mistakes and run afoul and end up, wiping ourselves out when it comes to investing. I mean, lifestyle and personal finance, that's probably a pretty easy one, right, Joe? I mean, what would you say is the number one personal finance rule to live by?
Live within your means.
Exactly. So, but what you see sometimes is you'll see some people have quick wins in the market or whatever. They extrapolate out those wins. Like, next thing you know, you're doing compound interest calculation. You're saying, wow, I'm going to be a gazillionaire within 10 years, or whatever. So then they end up, spending above whatever their income is. And as a result, that forces them to start drawing down and treating their trading account, their investing account, as their primary source of income.
Yeah.
And that is fine when the market's going good. Maybe I'm not going to say fine. It's not, you shouldn't do it.
I'd say it's pretty dangerous.
It's pretty dangerous. But the reality is that markets don't always go up. And when they start going down, you now have less and less money because you're living off of that money as well as trying to invest with that money. So lifestyle decisions. And I think that the number one thing you can do to avoid making that mistake is to always be living within your means. Just like you said it beautifully, Joe. And I hate budgets. I hate them.
Yeah, I think we all do.
Yeah. But if you know what your income is, don't spend more than your income. I'm not trying to be, I've seen that happen too many times, right? You go out and you buy the fancy Porsche because you think you're going to end up continuing making money forever. Or you don't ring the register and make that money real, whatever. And it disappears. So that'd be lifestyle. And then the second bucket that I would put a lot of the mistakes into, Joe, would be leverage. And you and I talk a lot about, have for weeks, and ever since we started recording, is the risks associated with leverage, right, Joe? We've got margin and options, right?
Yeah, absolutely. That chart that I just pulled up, for those of you who couldn't see it, just picture a cliff. That's essentially what I pulled up, except that the cliff was a red line. Uh, and it happens because people, people on Reddit, or people who are just day trading for fun, they get a bunch of money in their portfolio and they get really smug, and they feel invincible because they're 22 years old and they've got $200,000 in their portfolio, and they're like, yeah, YOLO, I'm gonna trade some options. And we've advocated against options so many times on this show, and furthermore, you advocated against options so many times in the How to Talk Stocks class, that we we probably sound like broken records at this point. But
Yeah, and I mean, sure, if you're a highly sophisticated investor and you've been at it a long time, and maybe you're writing options or you're doing very sophisticated options strategy that can control your risk. But if you're just going out and you're buying a short-term expiration option, thinking, hey, I'm going to hit a home run, eventually you will wipe out. You'll wipe out. You may look like a superstar. And, the opposite, like you said, the mirror image of the chart you shared. In a way that contributes to a lot of other people saying, now I'll take on that risk because look how good he's doing.
Yep.
And it's that fear of missing out. So you're seeing that and you're saying to yourself, oh, I got to get on board this or whatever. But again, the use of that leverage works. It works until it doesn't. And I think that one of the things that people need to remember, and I think the Robinhood is a really good example of this, the rules can change. The rules can change. Listen, if Robinhood hadn't changed the rules, no matter what tennis says, they faced a liquidation crisis.
Oh yeah.
You could have woken up, and it wasn't just that you couldn't trade those 3 stocks and then eventually 17 stocks or whatever. You would have woken up and not been able to trade anything.
There would have been a run on Robinhood.
Your accounts would have been locked.
Yeah, in the same way that there were runs on banks during the Great Depression. Yeah. It would have been the exact same thing.
Right, and guess what? You don't have FDIC insurance like you have at a bank. You have something called SIPC, SIPC. They only guarantee you the number of shares. They don't guarantee you a price or a value. So you own 100 shares of GameStop. Guess what? You wouldn't even have been able to sell them. You couldn't even have been able to sell them. You just would have at some tight date in the future, SIPC would have made you whole with giving you your 100 shares or whatever it was they happen to own. So I mean, this was a good reminder that the rules can change, and one of the things, the rules that can change is margin requirements. You can go in and they can say originally to you, okay, we're going to allow you to margin, and you don't need to have 50% equity. They can change that and say, no, you need to have 80% equity now. And you're like, well, you lent it to me at 50%. What do you mean it's 80% now? Right? Or whatever. And then you would have to either come up with the cash out of your own wallet, or they would say, we're liquidating it for you. And you'd wake up the next morning and I've been there, Joe. I've been there. I've had forced liquidations because I've looked at it and said, I'm not going to give any more money chasing this bad stock. I'm just going to YOLO it. And if it goes up tomorrow morning, I'm bailed out of my margin. And 9 times out of 10 times, no, you won't. You'll get forced liquidated out of the name and you lost it.
Don't use margin, listeners. That's the lesson. We've said it so many times before.
Right. I mean, I think that there are times but for most people, listen, it goes into my third thing, mindset. So again, the 3 reasons that people wipe out oftentimes are lifestyle, leverage, and mindset. If you invest with a cash account and you don't use leverage, you can be better about sticking to your rules. You can be more systematic, and you can be less emotion driven, because the last thing you want when the market is collapsing is to be worrying about a shifting margin requirement and a margin call. You want to have your list up of top stocks to be buying on sale and buying those names. You can do that if you're in the right mindset. If you're chasing your tail and worried about wiping out, I guarantee you'll just compound problems. You will make more mistakes. So you've got to have, I guess the final thing would be, have the right mindset, be rules-based, be system-driven, be unemotional. And as Joe, you and I have said on the show before, you plan your trades and you trade your plans.
Yeah, I hate to say it, but this kind of reminds me of what I've been told to do in a casino, where you walk in with, so if if you go to, whether it's Foxwoods in Connecticut or you go to Caesar's Palace in Vegas or something, the same rule applies. You walk in with a certain amount of cash in your hand that you're comfortable losing. Once you lose that cash, you leave. You don't go back to the ATM and get more cash to keep gambling. So it's a sign. Like, if you bring in $300 and you lose it in 20 minutes, get the hell out. don't take another $300 out of the ATM and then sit back down at the blackjack table.
Yeah, and that happened to me one time. I was down in DC, and I went to I can't remember which casino it was, but I went in and I brought a certain amount of money, and I don't know, my luck was just not with me that day, and I was playing blackjack. I should have been able to stretch it out way longer than I did, but I was like out of the game in like a half hour. All my friends are running around still having fun, and I'm like, well, I'll just watch them play. And that's the mindset thing, right?
Yeah.
You gotta be able to watch them play and be okay with it and be like, okay, you make your money.
That takes some principle and some vigilance. So yeah, good for you.
The other good advice I had gotten at one point in my life when it came to gambling from actually a former employee of mine, great guy. We went down together to a place in Connecticut. And, he's like, what I do is I have the money that I'm willing to gamble in one pocket, and I put my winnings in the other pocket.
The money I've heard that too. Yeah.
Pocket is gone. I'm done. So you could still have winning, you could still come out ahead because you use two different pockets. Right. And I was like,
yeah, that's a very good strategy as well, that you can, I probably wouldn't translate that to investing, because then you're just saying once you make gains on everything and sell, never reinvest. That's probably not the best way to do it. But yeah,
right. If we have people who like to go to casinos as entertainment, maybe that's something they could.
Absolutely.